All right, certainly a lot of emotions and commentary as far as gold is concerned. Remember, just about a week or so ago, we saw prices go right down below the 1,200 level, but especially as geopolitical tensions and a lot of noise emanates from the Eurozone and elsewhere. Look, certainly gold has caught a little bit of traction and currently sitting at 1,252. But remember, this precious metal did see a record decline from the past couple of months, down over 20%. As you heard there, many still think there is still upside for gold. We have a panel out there, certainly one bull, one bear. Let's get these two opposing views on exactly where gold is going to go. Sitting right here on set with me is Mark Keenan, cross-commodity research strategist at Société Générale, who is a bear on gold markets. And all the way from Las Vegas, we have Anthony Blanchard, CEO of Anthem Vault, joining us from the United States. So let's kick it off with you. You're not the only one who was bearish on gold, but right now, all of a sudden, we have a spike up in geopolitical tensions, whether you look at Egypt, whether it's the Portuguese drama or even the Greek drama, and a lot of concerns about what all of this is going to mean, especially as energy prices pick up, maybe inflation picks up. Do we need to adjust any of our positions?
We don't think so. Really, the dramatic sell-off in gold that we've seen this year in April, and combined with the prospect of the Fed ending its QE program this year, has really catalyzed a paradigm shift in the minds of many investors. And as you said, many people were bearish earlier on in the year. We were very bearish very early this year. We had a year-end target of 1375 for gold, and that was reached very quickly in April. And that's prompted us to revise our target down yet further for the year, and we see 1,200 for the end of this year in terms of Q4 average. And frankly, going forward, year after year for up till 2017, we see about $50 coming off the average price per year, down to $1,000 by 2017.
Down to $1,000. Let's also get straight out to Anthony Blanchard, who believes that now is similar to what we saw in January 2010, very bearish, but we could possibly see upside of as much as 30%. So tell us your case.
Well, I think really the case is to be made is that there is so much bearish sentiment out there in the markets. We've had record net short positions in the COMEX market. We've had a lot of action and very, very speculative short hot money in the hedge fund market that's pushed down gold here. And fundamentally, if we look at Asia, if we look at China, we've had massive amounts of physical buying over the last 12 months. If we look at India, there's been so much physical buying that the government actually had to place an 8% import tariff because it was affecting their account deficit so badly. So these are countries that have experienced hyperinflation before. They've experienced issues with credit risk and financial risk, and I think it's very interesting that we've seen a lot of issues in terms of the interbank lending situation in China. We have a lot of shades of 2008 in the United States, and I think that the market's sensing that, as opposed to what the Fed is saying and being able to somehow have a illusion of being able to taper, I mean, bet begets more debt. And in terms of the amount of debt servicing that has to occur, we already have record low interest rates, and there's really no lower that the Federal Reserve or these other central banks can get to, and they're going to have to continue to monetize more debt in order to keep debt servicing levels of their governments stable.
Yeah, so debt monetization, Mark, alongside Chinese Indian buying, is this going to give gold any bit of traction?
Well, it's an interesting question, and we've done some analysis on the impact of physical buying. That has been indeed substantial, specifically following the April sell-off. And we saw that in physical premiums in markets like India, and that has relaxed somewhat in alignment with the Indian taxes that they've placed on imports. With physical buying, it's such that physical buying definitely adds support to a market. It can establish very strong bases at times. It can catalyze short covering rallies as well. But it's very rare to see a sustained up move in gold as a function of physical buying. Gold is very much a sentiment-driven market. Most of the price appreciation that we've seen over recent years has been a function of its use as a hedge in inflation.
Right.
And now that really seems to be waning.
Yeah, but can this change? Anthem, jump in here. The spike up in geopolitical tensions, energy prices at 14-month highs, and possibly rising further. Can they get gold? Can this get gold back in favor again, do you think?
Well, it very well could be a catalyst. I think there was a huge over sell-off. We haven't seen a sell-off this dramatic in over 30 years, and yet all of the fundamentals are still in place. We still have a very weak economy. The jobs numbers are tepid at best. We've had a lot of months in a row now below 200,000 jobs in the non-farm payrolls. We have very low GDP growth. We have participation in the labor market here in the U.S. falling, and at the end of the day, the U.S. dollar still is the world's reserve currency, and so that's why all eyes need to stay glued on the Fed, and that's why I think we're going to see the big surprise being that instead of tapering in September, I think that the Fed is going to have to hold steady, and I think eventually going to have to announce more QE. I think that they're going to have to continuing to...
Yeah, but what about Jeremy Stein's comments recently? Yeah, what about Governor Jeremy Stein's comments recently that maybe 200K isn't the number that we need to look out for, and that's no longer the goalpost?
Well, I mean, I think that there is a lot of validity to that because you ultimately have to have at least 200,000 a month in job growth in order to even, have a dent in terms of the unemployment numbers. So really, that to me is just the baseline. So we've had so many months of negative growth, and it really is, I think, a situation we've seen all of these trillions of dollars of liquidity that have been pumped into the market, and I think that it's ultimately kept the market a lot higher than it really would have been otherwise, but I think that we really have a lot of phantom growth, and I think that the Fed is not going to be able to stop tapering. I think that the Eurozone is extremely vulnerable. I think we've seen that with the rise in interest rates here recently in the Treasury and what kind of effect that's had globally. So I think that it's very, very dangerous situation here for all of the central banks. They have to ensure that price deflation goes away. At the same time, they have to be very, very weary of starting a price inflation from monetary expansion because it is extremely, extremely difficult to get that cat back in the bag once it's out. So,
and as far
very
as
precarious situation, very bullish for gold and silver.
Oh, yes. You think it's very bullish. So as far as the jobs number is concerned, how do you think that is going to affect gold and silver?
We see, if we rewind somewhat and we look at the lines and the indicators that were set in place where the Fed would have liked the economy to arrive at in order to reduce the QE tapering, we see that has been relaxed somewhat. Originally, I think it was around the unemployment level down to 6.5%, and only at the last meeting we saw very optimistic comments from Bernanke that the QE program is going to end. Now, the thing with that, and going back to gold's importance and sensitivity to market sentiment, is that it responds very, very actively to this. The ETF market is an extremely interesting dynamic in gold, in that it has extreme visibility. Everyone is very aware of movements in it on a daily basis. And it's substantial. It's very large. I mean, the current selling this year alone of around 580 tons. If we put that in context, that is equivalent of 3 years of output from South Africa. The size of this ETF is equivalent to the third largest central bank in the world. And we see continued selling on this. We see around 800 tons coming out of this for this year alone. And next year moving forward around 500 tons. And so whilst it's interesting to interlace physical demand into this and look at physical buying, which has increased definitely, specifically in the jewelry sector, and we see very strong growth in that. The jewelry sector is very responsive to prices naturally, but that really can't compare with the size of the liquidations that we're seeing in this ETF market. So obviously gold, silver, a very emotional subject, as we can see from our panel. Gentlemen, thank you so much for your time. We hope to repeat this again very soon. Mark Keenan of Société Générale and Anthem Blanchard, CEO of Anthem Vault there. We appreciate